Now, in a bid to contain the most intense inflation the U.S. has seen since the 1970s, the Federal Reserve has decided to raise its target for short-term interest rates by 25 basis points. This is the first time the Fed has hiked rates in 3 years. Shin Ye-eun with this report.
For the first time since 2018, the U.S. Federal Reserve raised interest rates by 1/4 percentage point. The policy-setting Federal Open Market Committee on Wednesday decided to increase the federal funds rate to a range of 0.25% to 0.5%. For consumers and businesses, this increase in short-term interest rates will mean higher rates for loans. Fed Chairman Jerome Powell explained that the measure is to restore price stability amid sky-high inflation that has been running at the highest levels in 4 decades. Powell expressed some optimism, forecasting that the hike in interest rates would be a stepping stone for stable growth.
Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024.
But the GDP growth projected for this year is lower than what had been forecast in December. Back then, Fed policymakers had expected the economy to grow by 4% at a time when the biggest economic threat was thought to be the pandemic. But now the Fed has detected new risks facing the global economy, mainly the invasion of Ukraine and spiking commodity prices. The Fed also believes inflation will stay above its annual 2% target, even with 6 more interest rate adjustments expected between now and the end of this year. The central bank's policymakers expect inflation to remain elevated at 4.1% until the end of 2022. Shin Ye-eun, Arirang News.